Treasuries are fixed income investments issued by the U.S. government through the Department of the Treasury to raise money for government expenses and to pay the nation's bills. They're considered one of the safest investments because they're backed by the full faith and credit of the U.S. government. Many investors like Treasuries because they provide income and return the invested principal. In this video, we're going to show you how to buy new issue Treasuries from U.S. government auctions using tdameritrade.com. Investors can buy Treasuries in the primary or secondary markets. In the primary market, the U.S. government offers new issue bills, notes, and bonds at weekly auctions. These auctions are generally announced every Thursday and take place the following week. An auction opens with the government offering a Treasury at a low yield and then raising it until it finds willing bidders. Auction participants are mostly large institutions like banks, insurance companies, foreign governments, so on. There are two types of bids, competitive and non-competitive. When the Treasury Department is raising the auction yield, it's taking the competitive bids. After the competitive bidding is over, the orders for non-competitive bids are filled at the average yield of the day. TD Ameritrade is normally a non-competitive bidder. If investors don't want to bother with the auction, they can purchase Treasuries from other investors in the secondary market. This is where previously issued fixed income products are bought and sold at varying prices and yields depending on supply and demand. Many investors like to buy Treasuries at auction because they get a similar yield to everyone else instead of having to pay whatever price the secondary market is offering. Additionally, buying at auction doesn't have some of the additional costs of the secondary market, like potentially needing to pay a seller accrued interest. With that said, when you buy a Treasury at auction, you're limited to what is being sold that day. So if you're looking for a 10-year note and the Treasury is selling 8-week T-bills, you may have to wait a few weeks before the notes you want are available. However, you could probably find a 10-year note in the secondary market immediately. So how do you buy a Treasury at auction? You can find Treasury auctions on tdameritrade.com in the Research and Ideas menu under the Bonds and CDs section and select New Issues. Next, select Treasury auctions either here or here. This is a list of upcoming and past Treasury auctions. Notice the wide range of Treasury types. Let's break them down. Treasury bills, or T-bills, have a maturity of 1 year or less. They're usually worth $1,000 at maturity and are sold at a discounted auction. For example, an investor might purchase a 1-year T-bill for $950, and when it reaches maturity a year later, the T-bill will be worth $1,000, a gain of $50. So at auction, the bigger the discount, the higher the rate of return. Treasury notes mature in 2 to 10 years, while bonds have a maturity of longer. Like other bonds, they're issued with a face value of $1,000 and a coupon payment that is made each year in 2 payments 6 months apart. At maturity, a bond is redeemed at par value, which is the same as the face value it was issued at. There are other securities issued by the Treasury as well. TIPS, or Treasury Inflation Protected Securities, are tied to the Consumer Price Index, or CPI, which measures inflation. TIPS work like other notes and bonds, but they also rise and fall with changes in the CPI, making them more volatile than other Treasuries with similar maturities. From time to time, you may also see an auction for a FRN, or floating rate note. FRNs usually mature in 2 years. The return on a FRN is tied to the 13-week T-bill plus a small spread. If the yield on the 13-week rises, then the FRN will pay more. If it falls, the FRN will pay less. Now let's break down the rest of the information you'll see here. Under the Select column, you can choose which auction to participate in by selecting a security that is being auctioned. Today, you could select a 13 or 26-week Treasury bill, or a 3, 10, or 30-year note. The Issue column provides a brief description of the securities being auctioned. The Auction date tells you when you can expect your order to fill. This column shows the minimum quantity you can buy. If you decided to buy 1 Treasury at face value, you'd expect to pay $1,000. This is the maximum number of treasuries you can buy, which is 10,000. If you have a spare 10 million, you're in luck. We can help you with that. Announcement date shows when the auction was announced, and settlement is the date that you'd assume legal ownership of the security. So, let's say you want to buy a 13-week treasury bill. I'll select it. Next, I'll enter 1 in the buy quantity box. Finally, I'll click Review Order. Now, quick note. Before buying a treasury security, consider how it fits into your overall portfolio. If you want a longer or shorter term bond than what is currently available, you'll need to wait for another auction or buy it in the secondary market. You could buy from the secondary market using the bond wizard here. Now, back to the example. The review screen shows you some of the same information you saw previously. One thing to note is the coupon. This is how much interest the issuer is paying, and it'll be determined at the auction. You can check the U.S. Department of the Treasury's daily Treasury par yield curve rates to get an idea of the potential coupon rate. Moving on, if we're satisfied with our order, I'll click Place Order. In this example, we submitted an order to buy a 13-week Treasury note. After settlement, we would expect to simply wait until it matures to get the interest and the principal. If we sold the bill in the secondary market before maturity, we may get more or less than we paid for it. Adding treasuries to a portfolio is one way to diversify and attempt to take advantage of higher interest rates. Buying treasuries through an auction can help investors avoid some of the additional costs of the secondary market, which can make fixed income investing simpler. Just remember to closely consider which investments best fit your strategy and timeline.